Welcome to the Deep Dive. If you need the fastest, most effective shortcut to being completely informed on the market's volatile action, you are definitely in the right place. Our mission today is pretty laser-focused. We're doing a rapid deep dive into the last 24 hours of major U.S. stock news, and we're pulling insights from a pretty dense stack of filings, analyst reports, and news items. We're talking over 30 companies as of this morning, November 14th, 2025.
And for you, the listener, the goal here is not to get lost in those 30 tickers. It's really about extracting the strategic knowledge. We're cutting through all that noise. Because, some sectors just roared to life and others, well, they just kind of stuttered. We want to pinpoint those aha moments for you.
Right. So you know exactly what drove those big price swings and what signals the executives are sending. Okay, let's unpack this, and I think we have to start with the biggest headline movers. The market action was really defined by two massive, and contradictory earnings reactions.
It really was. Let's lead with the unmitigated success story. Own All In, that's On Holding AG, the running shoe company. They delivered what analysts are just, universally calling a blowout quarter.
A blowout. And the stock reacted, surging over 18%.
Ooh.
But what was the absolute core catalyst? It's often not just the top-line revenue number, right? It's the efficiency.
You hit the nail on the head. So while net sales increased a really robust 24.9% year over year, which is great, the real story is profitability and margin. Their earnings per share, the EPS, came in at a remarkable 50 cents. That just crushed the analyst consensus of 34 cents.
Wow.
And critically, their gross profit margin, that's the money they keep after actually making the shoe, it reached a new high of 65.7%.
65.7%. That's huge for an apparel company.
Right.
So that's the strategic signal, isn't it? They're not just selling more, they're making a lot more money on every single pair.
Exactly. That financial strength, that margin expansion, it allowed the company to raise its 2025 annual revenue guidance. And that confidence, that signal to the market, it immediately translated to analyst upgrades. UBS, for example, raised its target price from $79 to $85. It was a textbook breakout.
Okay, now let's pivot hard. Let's go to the complete opposite end of the spectrum. Walt Disney, ticker DIS, a massive 7.8% drop, even though they beat on adjusted earnings per share. This is where it gets really interesting to me. How does a company like Disney beat on the bottom line and still lose billions in value?
It's the painful story of transition. And it's about the market's impatience with these legacy business models. So look, Disney's Q4 adjusted EPS of $1.11 did beat the street's $1.03 expectation. But, and this is a big but, their total revenue of $22.46 billion missed the $22.7 billion estimate.
So the market decided that a $250 million revenue miss mattered more than the EPS beat.
It did, because of where that miss came from. It was from a very specific and fragile place. The rapid decline in profit from traditional linear TV. The cable segment.
The dead weight.
The market sees it as a dead weight, pulling down all future growth, yes.
But hold on, wasn't there a huge silver lining here? Something everyone was waiting for? I'm talking about the streaming business finally turning a profit.
There was. Their direct-to-consumer, or DTC segment, that's streaming, it finally hit profitability. We're talking $352 million in operating income, and they added 12.4 million subscribers.
So isn't that the strategic goal everyone wanted?
It absolutely is the goal, but the market's reaction suggests they see that streaming success as just, as a necessary offset to the bleeding cable segment, not as a driver of net new growth. Not yet.
So the future success isn't outweighing the past failures?
Not yet. The traditional drag is winning the emotional battle right now, and that's what drove that 7.8% drop.
That makes our third major earnings shockwave even more perplexing. Celsius, CELH. They beat on both EPS and revenue, yet the stock plunged over 20%. So if beating expectations isn't enough, what is the standard?
The standard is the future outlook. It's always about the future. The market didn't panic about the great Q3 numbers they just posted. They panicked about the forward-looking guidance. Specifically, investor worry was all about future margin pressure. From increased distribution costs, it's all related to their massive transition to the PepsiCo distribution network.
So they're worried about the short-term pain of what is really a long-term strategic move.
Precisely. They are taking on higher costs now to get that exponential reach later, but the fear of reduced profitability next quarter completely overshadowed the excellent performance this quarter.
It's a classic case of guidance, just killing a great earnings beat.
It is.
And then Celsius reacts almost immediately to that plunge. They approved a $300 million share buyback program. So if management is that confident, why are investors still so anxious?
It implies a huge disconnect, right? The company's leadership is sending the loudest signal they can. They're saying, we think our stock is deeply undervalued. But the average investor is just focused on the immediate risk of those rising costs. It just confirms that in today's market, guidance often outweighs history.
Okay, let's pivot from all that earnings chaos to strategic expansion. We saw several major companies, from fintech to digital health, making some really aggressive moves. They're trying to widen their core business, leverage their existing customers, and reduce their reliance on their original bread and butter.
And nowhere was that clearer than in fintech. Robinhood, ticker ATID, had some of the most fascinating news, really confirming their push beyond just being a brokerage app.
The partnership with GoPuff,
Right.
which sounds almost absurdly convenient.
It is aggressively convenient. I mean, this new service lets Robinhood users withdraw physical cash from their accounts and have it delivered to their doorstep by GoPuff.
Wait, really?
Yes. Think about the strategic implications. This is Robinhood trying to become a real-life financial utility. They're moving into banking territory, blurring that line between digital assets and physical cash.
So now I can literally order cash along with my late-night snacks. That is a very modern take on financial services.
It certainly is, and this strategy fits perfectly with their other expansion signals. The CEO, Vladimir Tenev, recently said that the prediction market is the fastest growing business in the company's history.
Which is not their core business at all.
Not at all. It puts their whole strategy into context. They're using their massive user base for all these diverse, non-traditional revenue streams.
And that user base is huge.
It is. Their October data showed $343 billion in assets under custody and 27.1 million funded customers. They're pushing those customers into new ventures like prediction markets and cash delivery.
Moving over to digital health, we saw similar expansion attempts. Tell us about Hims&Hers.
Right. So Hims&Hers launched a new comprehensive health check service called Labs. This moves them beyond just, specific prescriptions. They're getting into deeper health monitoring and data management.
Trying to build a stickier relationship with users.
Exactly. The holy grail of digital health.
And what about their competitor, Teladoc? TDOC, any movement there?
Yeah, TDOC saw some pretty significant analyst activity, which kind of reflects the general skepticism in the sector. Zacks Research just downgraded Teladoc's rating from strong buy all the way down to hold.
That's a big drop.
It is. And that news provides crucial context. Even as companies like Hims are expanding, the market is showing real caution about the sector's overall growth and profitability.
Let's shift gears again. Prop tech, the real estate tech space. Most players were pretty quiet after earnings, but CoStar Group, CSGP, was busy.
CoStar was definitely the most active data provider. They released two key market reports just yesterday. First, they maintained their U.S. retail projections through 2026, which suggests some stability there. And second, they put out a Homes.com report indicating that U.S. home price appreciation remained muted in October.
So they're positioning themselves as the data authority.
They are. They're strengthening their strategic position as the voice in both commercial and residential real estate data.
Okay, finally, in media, Netflix, nflx, they had a big technical event that listeners need to know about.
Yes, a 10-for-1 stock split. It was previously announced, but it's executing today, November 14th, after the market closes.
So trading at the new price starts Monday the 17th.
That's right. And on a, less core note, they also announced the classic game Red Dead Redemption is coming to their gaming platform, and they opened their first Netflix house.
A physical store.
A physical retail and experience venue. It just shows they're focused on both the technicals and brand extension.
All right, now for the quiet signals. This is where we stop looking at press releases and start digging into the internal documents. And what's fascinating here is just the sheer volume of insider selling reported across completely different sectors.
This is where we read the tea leaves, from the Form 4 filings. For anyone who doesn't know, a Form 4 shows when company executives or directors are buying or selling their own company's stock.
And what does it tell us when the CEO of a streaming company and the COO of an insurance company are both selling on the same day? Is it just tax planning, or is it something more?
It raises serious questions because it's so widespread. We saw major internal sales reported across the board. RKU CEO Anthony Wood sold 50,000 shares, and that just happened to coincide with the stock dropping 5.6%.
And RKU wasn't alone. We saw it in financial services, too.
That's right. At Lemonade, LMND, the insurance tech firm, the COO, sold stock valued at roughly $3.4 million.
Right.
And at Progressive, PGR, their chief information officer, sold stock worth about $295,000. And the list goes on. We also saw sales from the president of Wayfair, WME, and the chief legal officer of Hims&Hers.
So you have e-commerce, insurance, streaming, digital health. It's a cross-industry sweep of executives selling down their positions. That suggests a real lack of urgency to hold shares at these prices.
It's a powerful, if indirect, signal. I mean, these are the people with the deepest insight. Their widespread decision to reduce exposure can't just be dismissed as random.
But it wasn't all selling. We did see one notable institutional vote of confidence to balance things out.
We did in the food and beverage space. BellRing Brands, BRBR, saw a new institutional investor, Clarkston Capital Partners, establish a pretty significant new position.
How significant?
Valued at approximately $34.4 million. That kind of institutional conviction can often provide a floor for a stock price.
Let's wrap up with some analyst highlights and late-breaking context. We've got a truly interesting, non-traditional idea for Duolingo.
Yes. Duolingo, DUOL, was the subject of a fascinating analyst report. D.A. Davidson analysts published a report suggesting that the language learning company should acquire chess.com.
Acquire chess.com. That seems completely out of left field. Why would a language app want a chess platform? What's the logic?
The argument is all about synergistic user engagement. The analysts point out that Duolingo is ultimately a platform for learning complex skill-based tasks through gamification.
Okay, I see.
And chess.com is the dominant platform for a very similar type of cognitive skill learning. It's highly addictive, deeply engaging. It would provide a massive blueprint for diversifying Duolingo's content beyond just languages.
So moving from a language app to a full-on cognitive school platform.
Exactly. Now, they did maintain a neutral rating and a $220 target on the stock, but the idea itself shows analysts are thinking outside the box.
Finally, we had some crucial context just outside our 24-hour window for the volatile auto retail space.
Correct. Just before our window closed, Barclays initiated coverage on Carvana, CVNA, with an overweight rating and a strong $390 price target.
That's important context for anyone tracking that sector's extreme volatility.
Absolutely. Having a major bank put such a strong target on the company provides a new layer of foundational support.
So if we look back at this intense 24-hour cycle, the key themes are volatility, right? Driven by that earnings paradox, Onan soaring, while Disney and Celsius dipped despite beats. We saw strategic pivots everywhere, with Robinhood moving into cash delivery. And we caught those widespread signals of executives selling their positions.
You are now fully informed about the critical events that shaped the market over the last day. The message is clear. Companies have to aggressively pursue new, high-growth revenue streams, even if that transition hurts margins for a bit.
And this raises the final provocative thought for you. Given that companies like Robinhood are betting heavily on these non-core business lines, and Disney is relying on streaming to offset its legacy decline, how much longer will investors tolerate that kind of revenue pressure, even if earnings per share still beat expectations?
It's the ultimate question, isn't it? Can a strong quarter truly mask a crumbling structural foundation? The answer to that really determines market capitalization in 2026.
Something worth mulling over. Thank you for joining us on this deep dive. We'll see you next time.